Hey everyone, this is our week 4 and chorus wrap-up. So this week we got to spend a lot of time actually thinking about how, from an investor's viewpoint, how they value things that they are thinking of putting capital into the company. So sometimes they think about putting equity into the company, also known as stock. And we know that when investors are thinking about valuing equity, there are two methods that they rely on most often to evaluate whether or not it makes sense for them. The first is in terms of a discounted cash flow approach, in which case they forecast out cash flows that are relevant to them and figure out what they are worth today. And the other approach is that they use peer companies or benchmarks as a guide to figure out what something is worth to them. And so they're going to adjust these according to how your organization differs from your neighbors, for example. But that's, in a nutshell, how equity is valued. And so when somebody thinks about lending you money, or you've already borrowed money and somebody is thinking about buying it from somebody else who has lent you money, it's a little complex, but at the same sense, they're thinking about mapping out the cash flows that would accrue to them if they bought this loan from somebody else and what those things would be worth today. So it's not actually complicated. We just have to forecast out what the cash flows are that would accrue to the lenders and then what those things would be worth to us today. In addition, because we're working out future cash flows as well as the sort of the interest rate that they're going to get discounted at to determine what they're worth today, interest rates come into play. And whenever interest rates come into play, it's important to think about things like inflation, default, and whichever country you're operating from, as well as the company that you're borrowing from. Okay. And this is sort of the granddaddy of them all. How do you value an actual company or an organization? Step number 1 is to puzzle out the correct or accurate cash flows to forecast. That is, what are the cash flows that would accrue or be provided to potential investors of the or into the organization? And when we look at that, we tend to look at things like revenue, net of any expenses that they have, and then we also have to advance the notion that as investors, we want you to put money back into the business to grow. And so we want to understand what amount of capital is available beyond that, or do you need the whole thing in order to grow? No problem, but grow first and then pay us later. And so that's something that's really important, is forecasting out the cash flows that will accrue to potential investors and then figuring out what those cash flows are worth to us today.